A share is a portion of ownership in a company. In order to understand what a share is, we need to understand first what a company is. A company is a legal entity that allows its owners to conduct business under a separate legal identity, limiting their personal liability. We owe the idea of a company as we know it today to a couple of wig-wearing lords in the British House of Lords and a bootmaker named Solomon. In 1896, these gentlemen brought into being the concept of a fictitious invented identity that could be created by individuals and could get into business and succeed or fail independently from its owners. The new idea soon spread across continental Europe and America and became what we know today. So a company is created by individual or individuals who know the secret spell. Okay, they know the legal procedure, whereby some forms are signed and an identity number is provided by specific state offices. This number represents an identity that can buy and sell goods, provide services, open bank accounts, and even become bankrupt, all totally separate from the original founders. The original founders usually fund the newly created fictional identity with initial resources such as money, and in exchange, a share of the control over the company and part of the assets in the new fictional identity are issued. Thus, if 5 founders contributed $100 for the new company in equal parts, each one will get 20% of the total share of the new company. Shares are usually issued in financial terms. Therefore, if the company issued 10 shares of $10 value, each founder will get from the company 2 shares, $10 each. The company could even issue some nice share certificates. Shares represent an owner's right to the company's profits. If our newly created company earned $1 million and wanted to return $100,000 to its owners, each owner would get 20% of the total profit, or $20,000 according to his shareholdings. Shares represent also a claim over the company's net worth, what will be left of assets after all liabilities are settled in case of dissolution. If our company made $2 million profit and was to be terminated by its shareholders, it would first pay back all liabilities it had: suppliers, loans to banks, employees, let's say $1 million. The rest, its total net worth, also called equity or capital, of $1 million, would be divided between its shareholders according to their shareholdings at that time. Each one would get $200,000. Shares also provide the authority to make decisions concerning the company. So, for the company to decide to nominate a chief executive officer, fancy word for the top manager, a majority of the shareholders would need to approve of the decision before it could be done. In our case, a minimum of 3 shareholders representing 60% of the shares would have to approve for the proposal to be accepted. Shareholders can trade in the company's shares. They can sell them for cash or buy more of them, adding to their control and gaining a larger relative portion of future profits from the company the shares belong to.